I was talking to a large family office. They have like $1 billion plus that they've invested in equities, and they invested into 30 mutual fund, not mutual fund, 30 managers. And my simple advice to that was, what, I agree you've invested in 30 people, but then if you just combine everything, your portfolio is gonna be the same as a Nifty 50 or a 500. But then he was like, yeah, but then that's very boring. Yeah, I mean, what do I do at cocktail parties? It's very improbable for investors to hold on to winners for a very long time. Suppose you bought crypto in 2014, and you're sitting on gains of 100x in 2016. I mean, there's impossible for anyone to not just take the money out at that point in time. Even though it's 2018 and became 1000x or 2000x. So I think holding on to gains is very tough, to be honest. I don't know any investor who's invested in HDFC Bank in 95.
Once people hear your last name, how disappointed are they when they ask for a tip and you tell them to buy a passive fund? Hi Pratik, welcome to the Sensei Kujaku show. Thank you so much for coming on.
Hi Krish, looking forward to being here and looking forward to our conversation today.
Incidentally, we're recording on the 4th of June, which is the date that I would say sent a few shocks around the system. So without getting too bogged down in the politics and what should have happened and what shouldn't have happened, what is your overarching opinion on how investors should react to news like this, and more importantly, not overreact to news like this?
I think elections are a very funny, very funny time for the stock markets because people tend to overestimate the impact of macro events, and I think if you look at most at least macro events are obviously important because they could change a sort of trajectory of the government, but that happens because of not one action but like a series of actions can lead to countries doing well or badly. So I think people are expecting a clean sweep, but which did not happen, just like last time. So I think obviously the markets have reacted badly. So we did a study where we analyzed US elections for the last 50 years. And what we saw was that the correlation between market performance and election performance is actually not there. So it might have an impact on day-to-day stuff, but if you look at, say, over a year's time, it would be impossible for us to predict what would the outcome be a year from now. That's how non-correlated today's event was. So I think, yes, for traders, for someone who's looking at buying today, selling tomorrow, for them these events are extremely important. But for majority of people watching are investors. So for them, I don't think this is a big thing that has happened. The second thing is that in a country like India, we've never had, very rarely in the last 25 years we've had a majority-led government. It's always been a mixed bag. And despite of all that, we've had credible performance. Our stock market has compounded by 13 to 15% over the last 25-30 years. So I think we are a economy that does well not despite the government. So I think in that sense, whatever government comes in power, yes, certain sectors will do well, certain sectors will not do bad. But I think from an overall sort of investing lens, we don't see, or at least most of the experts don't see it impacting your long-term returns in a very big way.
It is something fantastically exciting about talking about these things. But ultimately, as an investor, I think it's clear that if you were in the right assets, and even if you talk just on equities, if you're in the right stocks, over time, no matter which government was in power, you ended up doing well. And that's actually the primary focus that I have for today's conversation, which is that you have to, as an investor, at least as a long-term investor, build a portfolio that can weather many storms that come along the way, right? So that involves not only proper asset allocation, but that involves risk management, and even investing in a variety of different types of assets, maybe beyond just equity and fixed income, right? Yeah. And you're the sort of ideal person to speak about that because you focus on so many other things. But I want to start with the first form of investing that I want to talk to you about is passive investing. Assuming somebody has decided to go down the passive route, whether it's 10% of the portfolio or 100% of the portfolio, What do you think is the correct way to think about that, and what is the best way to go about allocating capital to passive funds?
Yeah, so I think the good thing is that I think the question I used to get a few years ago was, what are passive funds? So now the question is, how do I use passive funds in my portfolio? So I think the conversation has evolved a lot over the last 5 years since we started. And I think if you look at passive funds, essentially, my personal, I think, mission is to increase the number of equity investors in India. I believe that to really create wealth, fundamentally, and if you look at every wealthy person on the planet, I think the commonality that you'll get is they own something. They own stuff. They own their own house, they own their own company, they own gold, they own real estate. So I think ownership is very important to create wealth. I keep telling people that they focus a lot on their salaries, which I think is important, yes, but that'll lead to your increasing that'll lead to increase in lifestyle. So you won't end up becoming liquid wealth. And to become liquid wealth, you have to own stuff. When it comes to owning something yourself, the asset class which will give you the highest return is equities. By far, I think the second biggest asset class is probably maybe gold or maybe fixed income, and equity does 2x of that. So I think in terms of return, and also equity is a lot more tax friendly. So I think higher returns, low taxes. Passive investing simplifies mutual fund investing. So I think it's essentially, if you really want investors to, which are mostly self-directed, who have come into the market in the last, say, 5 years, for them the simplest option is to buy a passive fund. And there you don't have to worry about underperformance, you don't have to worry about costs. What we've seen is passive funds are now top performing across categories. So if you want to buy a small cap fund or a large cap passive fund, it's always been the top profile. So if performance is good, cost is low, and if you had to invest for say 20, 30, 40 years, then it's very hard for you to choose an actively managed fund. A passive fund you can just invest and forget. So I think the biggest case for passive funds is simplicity, which is why I feel today most portfolios tend to have a 0% allocation towards passives. So what we are saying is that you have an allocation. I'm not saying have 100% in passive, but maybe have, say, there's something called a core portfolio, which is a part of your portfolio which you won't touch for a very long time. You'll probably hold it for say 10 years, 15 years, 20 years plus, or whatever it is. And I think that part of your portfolio should be in passive, where you just invest and forget. That's why I think passive is very important. Now under passives, most people think of Nifty and Sensex are the broad options. We believe they are actually not very good options. Now today passive funds are much more broader. You have passive funds across international, domestic, you have gold and silver. So you have passive funds across different categories. You also have some category called factor funds, which are getting very popular, where you can get high returns while I think keeping costs low. So I think when you look at how to build a passive fund portfolio, the broad-based index is good enough. Like a Nifty 100 or a Nifty 500 is good enough for your portfolio. But again, if you're looking for a commodity fund, look at gold or silver. If you look at international, you can look at S&P 500, NASDAQ. If you're looking at fixed income, you can look at a GSEC fund. So there's a lot of options that have come in the last 5 years. And I think that has made it easier for investors to buy passive funds across different asset classes.
What I have seen is that there's just so much fun people have in investing themselves. It's like you're at a party and you're part of the conversation. You're exchanging tips. Everyone's like, oh, you should invest in this. And there's so much gyan that everyone loves giving. Yeah. It's tough to compete with that, right?
No, I completely agree with that. In fact, I was talking to a large family office. They have like $1 billion plus that they've invested in equities. And they invested into 30 30 managers. And my simple advice to that was, I agree, you've invested in 30 people, but then if you just combine everything, your portfolio is going to be the same as a Nifty 50 or a 500. But then, he was like, yeah, but then that's very boring. Yeah. I mean, what do I do at cocktail parties? So, which is the same as investing in startups. I was part of the startup scene in San Francisco. I raised money from, we are part of a company that raised money from Y Combinator, and a lot of other VCs raised a lot of money and all that. And in the process, I met a lot of investors also. And angel investing is a write-off sort of a thing, But what I learned was it's a way of being relevant, being part of the industry, being part of events, all of that. So I think it has some prestige, even though it may not make financial sense. So I think people want to be involved. People want to have fun. What I tell people is that so before, my advice was don't have fun. Keep it simple. Restrict yourself. Don't give into the urge of speculation and fun. But now actually I don't believe that advice. My advice is to 90% of your fund, 90% of your portfolio, or 85, whatever you want, is to be invested in something very boring, and then you can have fun with the 15%, which is what you can play around with, experiment, learn something, speculate, talk about it at parties and all that. So I think if you have a portfolio of, say, I don't know, 1 CR or say 10 lakh rupees, then you could say invest maybe 7 to 8 lakh rupees in something long-term mutual funds that you won't touch for many years, at least 5 to 7 years. And then whatever, anything beyond that, you can have your fund. So you're not really spoiling wealth creation also. And if you think that 15-20% makes a lot of money, you can extend that. Most people would probably do badly. 99.9% would do badly with that fun stuff, fun money. But if you are able to create more value, then you can look at expanding that. But the idea is, have fun, but do it with a small amount.
As an investor in public markets, you can also invest in companies that offer passive funds to investors. For example, Motilal Oswal. How does a passive fund, passive funds as a whole, how do they affect the financials of an AMC, and how do they compare to the more traditional mutual funds and active equity funds?
Yeah, so I think every AMC will have a separate answer to that. Certain AMCs use passive funds to just garner AUM. For them, so a lot of CEOs have targets in which they have to stay in the top 5 or top 10 or something like that. So I think that might be a target. So for them, maybe offering passive funds at very low cost and all that might make sense. For us, honestly, we believe that passive funds offer profitability as well, which is what they do. For Vanguard is mostly passive and they're making tons of money. BlackRock is in the US is mostly passive and also making lots of money. So I think we believe that passive funds offer low margin but high volume opportunity. So if you're looking at overall market size, passive funds used to be about 2016, maybe 5,000-6,000 crores. Today which was less than 1% of the market. Today they're about 17% of the market. So almost 8 lakh crore is invested in passive funds. And this 17 can go to 25-30% over the next 10 years time. So I think if you look at the size, and the size of the market itself is growing by 15-20%. So I think overall you're seeing a huge opportunity where investors, you're looking at lakhs of crores coming into passive funds. And there I think there is opportunity for you to garner AUM as well as sort of create value. We also see it as like a tool for innovation. I think we were the first AMC to add broad-based funds into people's portfolios. Passive was only Nifty Sensex 5 years ago. Today there's passive funds across different categories. We were the first ones to introduce international funds into people's portfolios. First ones to add factor funds in your portfolios. So I think you're able to really innovate in a very meaningful way.
You've spoken a lot about inclusion and increasing the base of investors in India. And can you talk to me about how, especially if you're a new investor, say it's your first job, you're just starting to earn money, why is passive probably a great way to enter the market?
I believe that investing is best understood by doing it. You can't read investing by reading a book. You can't read. It's like learning how to swim, right? You have to jump in the pool. So I think passive funds make it easier for you to jump in the pool, to get access to equity markets, to build your portfolio, and then over time you can look at if you think you're proficient enough, or if you're able to give in time, then you can choose the right managers who can manage your portfolio. You can choose the right funds. You can choose the right stocks. But I feel for a beginner investor, I think you should look at allocating some of your money in a passive fund, because that just makes it easier for you to start investing. We've done a study where we looked at how much does an average investor make in India, in terms of performance, and what we've seen is that the index in India has done about, say, 13 to 15% over the last 10 to 15 years time. An average investor makes about, it's about 7 to 9%. That's it. So it doesn't really matter if you invest in an active or passive fund. the biggest enemy for investor is themselves. They tend to over-invest in good markets, under-invest in bad markets. They tend to switch mutual funds. They tend to sell underperformers, buy performers. So there's a lot of activity that people end up doing in their investments, and that is what ultimately leads to them making really bad returns over the long term. So I think the biggest enemy for investors is their own sort of psychology, and I think mutual funds obviously offer some help because they're a lot more stable than buying stocks. But even there, I feel like the average holding period now is down to 2 years. And 2 years is like, I mean, it's the worst thing you could do, right? I mean, equity investing should be minimum 5 to 6 years time. So I think the average investor is trying to trade with mutual funds, which I think is a very bad trend. It's a trend which destroys wealth also. So I think overall that's how. So we believe that obviously 7 to 9% is very bad. You could probably make that much in a fixed income fund. So why are you taking so much risk if you could just get the same in a FD sort of a fund? So I think investors the teaching on psychology is a lot more important, which is also why I keep telling investors that when it comes to investing, seek help. Don't do it yourself. There's a lot of people in the entire industry today, which is there. Whose full-time job is to just help you invest.
I have to ask you this question. Once people hear your last name, how disappointed are they when they ask for a tip and you tell them to buy a passive fund?
No, honestly, I don't. People have stopped asking me for tips. Yeah.
Is it because you keep telling them to buy passive funds?
I just tell them to invest in mutual funds, to be honest. I don't know if I probably get asked this maybe once every 3 to 4 months time, which I think is not that much. So not many people ask me for tips anymore. In the early days, when I joined the business in 2019, 18, 19, 20, people used to ask me a lot. But now no one asks me, so I don't know why, to be honest. But I also don't talk stocks. I tell people I don't look at stocks, unfortunately. And honestly, I also feel like tips are not great for wealth creation in general. So I think it's by me telling them that I don't have any tips, so I don't recommend tips, I feel like I'm doing them a favor by telling them that you should not use tips to try to create wealth or make money or whatever it is. I think ultimately what really creates wealth is time, and not really stock selection or anything else. So I think you have to just give it time, and I think tips are not really vehicles of time. So I think there's investors and there's speculators. You don't want to encourage speculation, and tips encourages speculation, which I think destroys wealth over the long run.
Pratik, I want to now come back to other forms of investing that you guys are trying to sort of educate investors on and hopefully have them participate through that. There's a really famous fund from the US and started by this gentleman called Jim Simons, who actually passed away not too long ago. And they sort of made quant investing really popular around the world. And there have been lots of people who've come over the years, tried to emulate what they've done. Can you, A, briefly explain what quant investing is? And B, can you explain how that is a good complement to traditional, say, mutual fund or long-term only investing?
6 out of 10 of the largest funds in the world are all like quant shops. So it's getting a lot of I think it's attracting a lot of smart people. It's getting a lot of AUM. And I think in India it's very early stages, but quant investing is now slowly picking up. But what is quant investing? I think if you look at investing, there's obviously that stock picking where you have fund managers who are trying to use fundamental technical data to pick the right stocks and manage your portfolio, which is your normal active investing. Passive investing is when you use certain rules to select which stocks go in. For example, an index fund will use size to select the stocks that go in and which go out of the index. That's a rules-based index, rules-based fund. Quant investing is very similar. It's essentially a rules-based strategy which deploys certain rules to do stock selection, buying and selling of stocks. The only difference between a quant fund and a passive fund is that in a quant fund the rules are proprietary. So the rules are not really I think, disclosed to the public. And that's because it's IP, right? It's intellectual property, and that's your secret sauce. So I think quant funds are essentially using rules, and these rules can be many rules. Jim Simons uses high frequency trades. He goes in and goes out of billions of dollars in a few seconds and captures opportunities there. There are people who invest for say 3 months, 6 months, 1 year using rules. There are something called low frequency, high frequency strategies. So high frequency is like you churn your portfolio every week or every day, versus low frequency is maybe once every 3 months or 6 months. So I think quant can be many things. People use fundamental data, people can use technical data, people use factors like momentum or volatility or fundamental factors. But so the idea is behind quant investing is it's obviously rules which are defined by the fund manager. But the second thing about quant investing is it's completely unbiased, which is what's the secret, which is why quant investing works. The problem with active investing is that active investing is not very consistent. If a fund manager has a philosophy, very rarely do they stick to the philosophy for life. You always make exceptions. That's one. Second is, there is some level of greed and fear that comes in. Suppose you have a stock portfolio of 25 stocks, and if 3 stocks are down 20%, it's very hard to really figure out what to do with those companies. Should I stay in or should I get out? And that leads to biases. So I think the investing bias is what quant investing is trying to relieve of, and that's why it does extremely well. The beauty about quant funds is that it's actually a black box strategy, but the rationale to why a quant fund is picking a certain stock is completely transparent.
Can you explain that?
Because the fund manager knows, right? So suppose I have a quant fund which is rules based, and I have this stock that comes in my portfolio. Now, if you ask, say, a stock picker, they will have a thesis on that particular stock, which may change over 3 months, 6 months, 9 months. For a quant fund manager, I'll be able to tell you exactly why a certain stock in a portfolio, what was the characteristic of that fund in a systematic way, in a data sort of way in which why the stock is coming in the portfolio and why it's left the portfolio. So in that sense, I feel like it's a lot more transparent in nature, because you have full and it's not about today, but also 3 years. So suppose I sold a stock from my quant fund 3 years ago. I have it in record and I know exactly why it got sold out at that point in time.
The advantage of, say, a traditional long-only fund versus, say, some of these more quantitative focused funds is there is a certain, for lack of a better word, art to investing, right? That there are things that you can't see on a balance sheet or in some sort of data. Just again, to give you an example, it's like if somebody were looking at HDFC Bank, say, in 1995 at the IPO, there is no data that can prove that or give you an indication that it would become what it became, right? So that's where the quote-unquote art aspect comes in.
No one predicted. I'm sure even the founders of HDFC didn't know where they were heading.
No, but so my larger point is that how does quantitative investing by definition preclude you from buying a diamond in the rough and then holding for the entire period? Or is there a way to capture that even in a quantitative fund?
It's very improbable for investors to hold on to winners for a very long time. Suppose you bought crypto in 2014, and you're sitting on gains of 100x in 2016. I mean, there's impossible for anyone to not just take the money out at that point in time. Even though it's 2018 and became 1000x or 2000x. So I think holding on to gains is very tough, to be honest. I don't know any investor who's invested in HDFC Bank in 95. And I don't know any investor who's invested in, Motilal Oswal 2007 also. So I think, except us because we run the company. But I think you're essentially trying to make the most of trends. You're essentially trying to, make the most of market trends. You're trying to sort of, be smarter than how the market allocates money, which is size-based approach. And you're trying to do it intelligently by using, by trying to deploy strategies which you think are a much better way of deploying money than by investing into an index.
Do you think there's been any evolution in terms of investor expectations of returns? And do you think that on average investors are almost deluded in terms of what they can expect realistically from the market?
I think it's a factor of age. If you are a 19-year-old or 20-year-old, your goal is to double your money every 6 months, and unfortunately they'll try it and they'll fail it. If you are, say, someone in their 40s, their expectation is to do roughly around the index, 1 or 2%, 12 to 15% is what their expectation is. If you ask someone who's, say, in the 60s or 70s, their expectation is to beat inflation, maybe around 7-8% post taxes. So I think it really depends on age. I think overall the average Indian investor has become a lot smarter. Their ability to withstand volatility has gone up, which is good. So I think, and their expectations also have come down. So an average investor, say 5 years ago, would expect 30-40% returns based on track record, past track record. They understand that if a fund is done that much, it's impossible for them to continue at this rate. So expect about whatever, around the index, a little bit more than the index. 5 years ago, investors didn't want 5% return also, which is what you would not advise that investor to invest in equities. But again, now I think people have become more mature. So I think overall it's good for the industry also. Yeah. But yeah, I think, as I said, I think it really depends on age and where you are in the market segment and all that.
Yeah. Pratik, another option that investors now have is factor investing. And I guess for a layman, often these things tend to overlap. Like, they're not entirely sure what the difference between factor and quant investing, for example, is. So can you explain briefly what factor investing is and how it's different from some of the other options?
Yeah, so factor investing is very interesting. It's actually a big category. So it's essentially, if you look at the US market, which is the biggest market in the world, the biggest category is broad-based funds, NASDAQ, S&P. In fact, 3 out of 4 of the largest mutual funds in the world are all S&P 500 index funds and ETFs. The second biggest category in the world is factor funds. So about $4.5 trillion is invested in factor funds. And India is still very early days, but we're seeing a lot of traction for factor funds. But essentially, the idea behind factor funds is that it gives you the returns of an actively managed fund. So it gives you an alpha up to 3-4% over the broad-based indexes, and also it gives you the cost of a low-cost index fund. So the cost of an index fund and the return on an active fund. So that is where factor funds come in. Essentially, factor funds are funds that are selecting stocks that have a certain common feature. So you have the four most popular factor funds across the world are momentum, value, low vol, and quality. A quality factor fund will essentially, invest in the companies that have the highest quality score, measured by, your return ratios, profitability, debt to equities. Then a momentum fund, which is the most popular fund in India, factor fund in India, will essentially buy stocks that have the highest price momentum. A value factor essentially buy stocks that have the lowest value by price to earning, price to book. So essentially, every investor who looks at these ratios is technically a factor investor. But what a factor fund does is systematically, is able to pick these stocks for you. So these funds are very popular. These funds, all 4 factors, have outperformed the index in India by 4 to 5% over the last 5 to 10 years' time, while obviously being very low cost.
And if you're advising, let's say an investor comes to you and says, I have 100 rupees, I want to put in between passive, quant, and factor investing, how would you, and say it's a young person, say in mid-20s or so, has presumably 50, 60, 70 years of investing left, what advice would you give him in terms of how he should allocate those funds?
Yeah, so I would say, when it comes to allocating 100 rupees, I would say the best way of allocating money is by allocating, first find your risk profile. Because your risk profile will determine your portfolio, your asset allocation. And I think over the long term, it doesn't really matter which fund you buy, which fund you sell, which stock you buy, which stock to sell. What really matters, your long-term returns is going to be a direct correlation to what your portfolio, what your asset allocation is. Say your equity portfolio is 60% or 80%. That will determine your returns in the next 10 years. Not which fund to buy, which fund to sell. Any fund will do well. So I think the first thing you should do is figure out your risk profile. Suppose there's a young person who's relatively risk taking, is able to take about 80% in equities. So I would suggest 75% in equities, 25% in a combination of fixed income and gold. Maybe gold can be 10%, fixed income can be 15%. Now 75% equities, you can do a combination of broad-based funds and factor funds. So broad-based fund like a Nifty 500 or a Nifty 100. We believe that Nifty 50 today is not a very good index because it's extremely concentrated. Top 10 stocks are like 60% of your portfolio.
So then would you say your equal weighted index is probably better?
Yeah, even equally weighted is good. Equal weight is good. Broad-based index. So go broad. Go broad. So 500, 100, and maybe do a factor fund like a combination of momentum and low vol is something I would recommend. So the 75 that you have, if you're investing only in passive funds, then you can look at half of them in say a broad-based index and half of them in a combination of equal weight, momentum, low vol. That's a very good portfolio to have. I would definitely recommend out of the 75, maybe put 15 to 20% in international funds. So what we've seen is the international funds give you the same returns as Indian funds, but the combination of international and Indian reduces your risk in your portfolio dramatically. When the Indian markets fall, regardless if you invest into a factor fund or a broad-based fund or an active or a passive fund, everything goes down. Whereas when you have an international fund in your portfolio, that will not fall as much as your India, and vice versa. So having say 15-20% allocation to international fund really helps your portfolio. So I would say you have your fixed income, you have gold, you have international, and then the balance can be in equities.
A question that I've often seen people have when they've invested in funds, now forget which fund, it's a mutual fund or some other passive fund or anything, is how much time should they give that fund in terms of judging whether or not they should stick with it or move to something else?
I think minimum 5 to 7 years time. You should not change on your portfolio before that. Every fund has a cycle. You might come in a bad cycle, you might come in a good cycle. So I would say don't look at performance for at least five years before you think of changing those mutual funds. I would say that if you're investing in a thematic fund or a sector fund, then yes, you should relook at it maybe in a couple of years because they are very cyclical. But if you're investing in any broad-based fund, then minimum 5 years should be your horizon. You should not even look at changing it, because fund managers do well, do badly at different points in time. So I think you should if you've selected a fund, give it at least 5 years for you to do well. And my belief is that churning portfolios is actually much worse. What we've seen is there's a good study done by an online, I forgot the name of the platform, but they have a lot of investors who sell underperformers and buy performers. And what they've seen is that if you do this continuously, your returns are actually fall by 2.5%, as opposed to just sticking to your underperformers. So if you keep switching your mutual funds every 2-3 years, then that leads to even lower performance.
What is your ambition for passive funds and everything else that you look at Motilal Oswal? Say from a 5 to 10 year perspective, what is your hope in terms of what it can be, the number of people you can reach through it?
Yeah. So honestly, I'm super I'm very excited about the future, to be honest. I feel like I'm very lucky to have this brand, and I'm able to really scale things up. Honestly, I feel like 90% of the work is done by the brand. I just do the 10% talking here and there, doing all this stuff. Having come in this setup for the last 5 years, now we have this belief that no, we don't have to predict, we can create the future. So, and I think we have the power and the brand to do it also. And we have done it. I think we're the first ones to really scale up passive in India in a meaningful way. Being innovators, pioneers, first ones to even international funds was something that we built as an asset class from zero, and now it's a very over-owned asset class. Quant funds also, factor funds also. My motivation is innovation. I have the capacity to fail, and I want to use that in a very big way. Someone has to, and I think success, innovation does not come from being right. It's about a lot of experimentation, and then hopefully something sticks. I've also failed a lot. I used to run this B2C investment company, which was like a robo advisory. So we put in a lot of I've put in thousands of hours, and build a proper business. But we couldn't really, we could scale it, but we couldn't scale our revenues as much, so we had to shut it down 2 years ago. And I've also launched a lot of funds that have not done well. So I believe that rapid experimentation is important. I think you have to innovate, and I think that culture of innovation is very inherent in Motilal Oswal. We were the first ones to launch a PMS back in 2003. First ones to go big in AIFs. Now we're the largest AIFs player in India, fastest growing AMC in the passive fund space. We have a lot of sort of innovative products that we've done. We were the first fund house to, when we first started our passive business, we were ETFs only. We did a lot of innovative products. So I think innovation is in our DNA, and I think that is something that hopefully we want to use in a meaningful way to create impact and to create wealth.
I have to give you credit for that innovation, right? When I first heard about Motilal Oswal as an AMC going heavily, focusing a lot on passive along with the more traditional products, to be honest, I was a bit stunned just when I think of the fact that as an AMC, you all are so synonymous with active management of equity funds and sort of equities generally. And I think it's so incredible that despite that history, you've been able to successfully balance both, right? And it's not about only one or the other.
When we launched our AMC business 2013, an active business, people were like, "Arey, you guys are brokers. What are you guys doing in asset management?" Right. 5 years ago, "Arey, you guys are active managers. What are you guys doing in passive?" At school is our tagline is still think equity, think Motilal Oswal. So I think we don't want to be associated with passive or active or broking or wealth. We want to be associated with equities. We really think that equities is an area which we understand very strongly. And I personally also I'm scared of fixed income, even though it's, if I had to allocate 5% of my portfolio to fixed income, I'd have sleepless nights. So for me, equity is just a safer instrument. I understand the risks involved, and I am very positive about its outcome over the next 5, 10, 15 years time. As a family, we're like 100% equities since like the early 90s, and we tend to be that over the next 10, 15 years time. Our balance sheet is 100% equities. So I think very high conviction in equities, which I feel that has really helped us, sort of get to where we are today, as a company.
Yeah. And I think a day like today is the day when you need that conviction, right? That if you can hold through a 7% index fall in a single day, it requires that, almost blind faith that ultimately these are fantastic companies, and you believe in the story that this economy and these companies are going to do well over time. Yeah. So instead of jumping in and out, just stay the course. And
yeah, exactly. I think staying the course is like, it's very, we've been saying it for like so many years now, and Warren Buffett's been saying it for like 50 years. As a company, we want to make sure that we are continuously educating people on the power of equities, on investing, on creating wealth. As I said, we are obviously equities, but we believe that equities can be like a foundation for a much better life in terms of creating wealth, and that's what we're trying to sort of invest in. But also we want to also talk about the psychology aspect as well. Like, no one really talks about long-term investing the way we do, and I think that's what we really want to ingrain. It's the product and psychology. Most people focus on product, which is why the insurance industry does well, because you're locked out. So even though the returns are very poor, you will make decent returns because it is a locked-in product. Whereas here, there is this urge of buying and selling, which is why a lot of investors, even though they come for creating wealth, they end up not making as much. So we really want to bridge that gap, and that'll happen through education, advice, hand-holding, all of that.
Pratik, I'm going to ask you to talk about the two men that have been instrumental in building this company, Motilal Oswal and Ramdev Agarwal. What have been your biggest takeaways in terms of what you've learned from them?
First, the most important thing is integrity. I think that is something that there's been zero compromise from day one. We paid full taxes for like 30, 40, 50 years. Since the company started, which, I'll be honest, was not a common thing 30 years ago. So I think integrity is very important. We're in a trust business. We're not an investing business. Number two is think big. Honestly, I think if you ask for their regrets, they'll say we didn't think big enough. So I think it's important to think big. It's important to dream. I think these would be two things I would say. So now they're thinking very big. We have this one tower here. We're gonna have 10 of these in the next year and a half, 2 years.
Oh, of course, across the country.
Across the country. Yeah. So number 2 was launched last week in Bangalore. We have number 3 in Ahmedabad in the next few months. So yeah, it's gonna So we hopefully have 10, maybe a lot more buildings. A lot more opportunity also.
Thank you so much for coming on. It was fantastic learning about so many things that don't often get spoken about. It was wonderful learning about that.
Thanks, Krish. Thanks for coming in, and hopefully we can do this again in the future. Absolutely. Thanks so much.